VWAP Wave System, Drysdale, every session opens with the same unanswered question. Is this a day the market will spend rotating inside a range, or a day it breaks out and goes looking for a new one? Drysdale built an entire trading framework around answering that question first before a single setup is ever considered. And this book is his full account of how core thesis. Drysdale spent years building and selling a multi-seven-figure digital agency before walking away from it to trade futures full-time, a shift he made around 2010. He now trades the S&P and NASDAQ futures alongside gold and silver, and teaches this framework through the Drysdale Trading Group, where a live trading community and a video course sit alongside the book itself. VWAP Wave System takes classical auction market theory and operates it with a specific repeatable toolkit, multi-anchor VWAP with standard deviation bands, volume profile, and point of control, and the initial balance used together first to diagnose what state the market is actually in, and only then to select from a small fixed menu of setups that matches the diagnosis. The discipline is explicitly conditioned first. Decide what kind of market you are looking at before you decide what to do about it, rather than reaching for a favorite setup regardless of context. Balance or price discovery. Drysdale states the premise as plainly as it can be stated. A market is always in one of two states, and the trader's first job every session is figuring out which one is currently true. Balance is a rotational market with agreement on price, value being built and defended, sellers capping the top of the range, buyers defending the bottom. Price discovery or imbalance is what happens once one side is taking control and is moving price to search out a new agreement, continuing until a new rotational balance eventually forms around a different level. Like the market profile framework it borrows from, this read is explicitly fractal. A market can be in price discovery on the daily chart while still sitting inside a larger balance on the monthly, and Drysdale reads multiple VWAPs together intraday, weekly, and monthly specifically to catch that layering. He also states the statistical lineage directly. This is market profile's own model and normal distribution turned on its side, with roughly 68% of a session's volume trading inside the value area, another 13% or so in the surrounding shoulders, and the remaining 2% out in the tails. The same statistics that describe any normal distribution applied here to price and volume. Instead, 3 tools for reading the auction. Drysdale is deliberate about not calling his toolkit indicators. He calls them auction tools, on the grounds that they read the auction structure rather than generate signals in isolation. VWAP with standard deviation bands, typically 1 deviation out and sometimes extending to 2 or 3, works as a continuously updating real-time proxy for the value area high and low. So the read does not have to wait for a full session's volume profile to finish building. Volume profile, value area, and point of control round out the toolkit, with the point of control acting as a magnet and pivot inside a range, and the value area high and low marking the edges worth fading while the market is genuinely in balance. An untouched point of control left over from a prior session, a naked point of control, is treated the same way as a VWAP bounce. Level institutions are still likely defending. The initial balance, the first hour of trade, rounds out the toolkit as a structural context marker rather than a trigger in its own right. None of the 3 tools is meant to be read alone. A deviation band without volume profile context is just a statistical boundary, and a value area without VWAP updating in real time is only ever as current as the last full session's cloths. Used together, the 3 are built to cover for each other's blind spots, the latter inside balance. While genuinely in balance, Drysdale describes price behaving like it is working through a predictable sequence of magnets. It tends to trade toward the value area high, and if it cannot escape value there, it retraces back toward the point of control. And if it cannot get past the point of control either, it heads back to the opposite edge. The latter is a genuinely useful mental model precisely because it is so easy to picture price bouncing between 3 shelves rather than drifting at random, and it gives a trader a concrete answer for where the next reaction is likely to come from, right up until the day it doesn't. This latter is what makes fading the extremes of a range the higher probability play specifically while the market is confirmed to be in balance. And the moment that stops being true, fading the same extremes becomes the wrong trade entirely, which is why the balance or discovery diagnosis always comes first. Not every touch along that ladder deserves a trade either. Drysdale has a memorable name for the anti-pattern of trading a touch of VWAP, or a band while price is chopping through a high-volume node, a thick, heavily contested part of the profile, rather than at a clean value area edge, calling it diddling in the middle. High-volume nodes are, by definition, where the crowd already agrees, which makes them choppy and low conviction to trade around. Low-volume nodes and genuine value area edges are where an actual decision is more likely being made and where his setups are actually designed to engage. 4 setups chosen by diagnosis. Drysdale states he trades the same 4 repeatable setups every session, selected by which state the market is in rather than by preference. Price discovery, continuation buys or sells, pullbacks to VWAP or the nearest standard deviation band once the market is in confirmed imbalance, and moving in one direction break except pullback go. Fade the value area extremes does the opposite, fading touches of the value area high and low, or the outer deviation bands, while the market is genuinely in balance. Return to value expects a swing back toward VWAP or the point of control once a price discovery move exhausts itself. Though Drysdale is explicit, this is not the same as mechanically fading VWAP every single day, since doing that indiscriminately produces outsized losers by ignoring whether the market is actually in the right condition for it. VWAP bounce waits for the market to spend genuine time trading outside the deviation bands, real evidence of momentum rather than a brief poke, and then treats the first pullback back to VWAP, not every touch that follows it, as the highest probability entry of the sequence. 4 setups is a deliberately short list. Drysdale has said he keeps a further set of advanced variations built on top of these 4 without laying them out in full in his public teaching, which keeps the core system small enough that a trader can actually hold every branch of the decision tree in their head. The Osiris Capital Trading Desk names a setup out loud in exactly this spirit as soon as one of its own defined patterns actually forms, and never before. It will call a fade at a level it has mapped as defended or a break worth joining once one has genuinely earned the name, but it will not invent a reason to speak when the tape has not actually produced one of the setups in its own book. Waiting for acceptance, perhaps Drysdale's most quotable discipline and the one most directly useful to anyone already watching a market's opening range is this. Do not call a breakout on the first push through a level. Wait for the market to demonstrate acceptance, holding and rotating on the far side of the level, before treating a breakout of balance as a genuine price discovery read rather than a fake-out that snaps back. Asked how much time that confirmation needs, Drysdale declines to give a fixed number, naming the transition zone between balance and price discovery as the single hardest, messiest read in the whole system and the most common mistake he sees in students. There is no shortcut here. The acceptance judgment stays irreducibly discretionary, sitting inside an otherwise mechanical framework of tools and setups. This is the same judgment the Osiris desk makes at the open of every session, grading the first minutes as a genuine trend from the open only once the move actually holds and rotates on the far side of the level being tested, rather than reacting to the first push through it. A first break gets watched, not trusted, until the market itself proves the difference between a fake out and the real thing. Risk, targets, and the next logical level. Risk per trade is capped at a defined maximum before entry, a fixed point or dollar ceiling from the entry price, treated as a hard boundary rather than a formula to be adjusted trade by trade. Targets are set at the next logical level generated by the auction tools themselves, the next VWAP band, the next value area edge, the next point of control, rather than an arbitrary multiple of the risk chosen independently of market structure. The stated logic is that a target divorced from actual structure is just a guess with extra decimal places, while a target anchored to where the auction is actually likely to pause is not. The Osiris desk enforces this same arithmetic without exception underneath every call it makes. A strict cap on what any single trade is allowed to cost, a hard limit on what the account can give up in a day, and a sizing check on every position before it goes on. So the size in front of a trader always matches the risk they actually intended to take. Discretion inside a framework and why most traders don't get paid. Drysdale states this is an explicit design principle, not an accident. The edge lives in the balance between purely mechanical rules and pure discretion, a defined framework of auction tools and 4 setups that houses a genuinely discretionary judgment call. Is this acceptance or a fake out? Is this a high volume node or a clean edge rather than eliminating discretion or relying on it entirely? Both halves of that balance matter equally. A framework with no discretion left in it would just be a set of alerts unable to tell a genuine acceptance from a fake out that merely looks like one, while discretion with no framework around it is just an opinion with a chart behind it. Drysdale's claim is that the edge only shows up when both are present at once. He is just as direct about why most traders still fail to get paid despite having a workable framework in front of them. And his answer is overtrading, not bad setups. His own description of what separates the traders who do get paid is narrow and almost boring. They keep to 1 or 2 instruments, 1 or 2 favorite setups, take them within an hour or 2 of the session, and then stop rather than staying glued to the screen hunting for opportunity all day. Bottom line, this book's real contribution is the order of operations it insists on. Diagnose the state of the market first, balance or price discovery, then and only then select from a small fixed menu of setups built to match that diagnosis. The tools are almost incidental. The discipline of never skipping the first question is the entire system. Skipping that first question is the single most expensive habit a trading tool can enable, and the Osiris desk is built to make sure it never gets skipped. An advanced platform for trader development and disciplined trade management, and the flagship of Osiris Capital. It grades every open as rotation or genuine expansion before it will back a single call. It names a setup only once the tape actually matches one in its own book, and it waits for acceptance on a broken level rather than trusting the first push through it. It runs that same diagnosis first every session until reading balance against price discovery is simply how you trade.